So this is absolutely crazy. Over the weekend, President Trump tweeted the idea of creating a 50-year mortgage as a way to help lower payments for people who want to buy a home. And I know I might get some pushback for saying this, but to me it's obvious. A 50-year mortgage is an absolute disaster waiting to happen, and no one should ever take that option. Ever. In fact, a 50-year mortgage is completely uncharted territory, and if one thing goes wrong, it could completely devastate both the housing market and the borrower. So let's talk about the actual math behind getting a 50-year mortgage, if and when it ever makes sense, and my own thoughts as someone who's been in real estate since 2008. Because I gotta say, most people have very little understanding with how this works and why it's a really, really bad idea. Alright, so to start, let's talk about where all of this begins. The 30-year mortgage. For those unaware, this was initially created in the 1940s as a way to help finance the construction and sale of new homes after World War II. And then by the end of the 1950s, it was adopted throughout the entire market as a way to incentivize families to build long-term equity. Well, wouldn't you know it, these days, the 30-year mortgage has become so popular that more than 90% of buyers pick a 30-year term on their mortgage. Now, obviously, there are more options today for buyers to pick from, like an adjustable rate mortgage, interest-only mortgage, 15-year terms, and so on. The options are pretty limitless, but the 30-year term is often seen as the safest. It offers the most flexibility, the most stability, your price is fixed until the home is paid off, and if you qualify, they're pretty easy to get because almost every bank offers them. However, there is a bit of a catch, because your interest payments are front-loaded towards the beginning of the loan. For example, with any fixed-rate mortgage, your monthly payment is split into two parts: principal and interest. In the beginning, most of your payment goes towards interest because you still have the full loan balance, and so very little of your monthly payment actually pays down the loan. But as time goes on and your loan balance gets smaller, more of that payment begins going towards principal, and over time, you could finally start building equity. At first, your monthly payment consists of almost all interest, but by the time year 20 comes around, this flips to the point where most of your payment becomes equity. And that's where things get very interesting. See, the typical person only keeps their home for an average of 12.3 years, meaning on a 30-year loan at 6% interest, they've barely begun to pay off their mortgage by the time they sell the home, get a new loan, and start the process over again. Even if they kept the home for the full 30 years, they will have paid $1.2 million to buy that $600,000 home 30 years earlier. When you look at a 15-year mortgage, you're going to notice that your monthly payments are significantly more expensive. And here is a real example of a $500,000 house, 6% interest, 20% down. If you pick a 30-year mortgage, your monthly payment's going to be about $2,400 a month.